This Road to Prosperity video is sponsored by Vandergraaf. Visit vandergraaf.com to learn more about how their advanced drum motor technology reduces maintenance costs while delivering reliability and longevity for belt conveyors operating in the harshest of environments.
I know a little bit about you and your history based on what's on the website, but I'm always kind of eager to know like why this industry. It's not really one that people think about when they're young, growing up, thinking about careers, unless you're family oriented. A dad or a grandfather was kind of already down that path. But what's your story and what's your connection to our industry?
Yeah, no, it's I'm probably one of the rare guys that I always knew my entire life what I wanted to do. Family business. One of my first memories probably being 4 or 5 years old, having my dad take me to a job site, just walking the job site, getting my boots dirty. Kind of fascinated by it as a young boy. Always went to the plants with my dad on the weekends. Started working in the warehouse when I was 12 for the summers, sweeping warehouse floors, doing all the dirty jobs. Pretty much just stayed around the shop all the time, learned how to operate equipment. I can drive dump trucks and ready mix trucks before I was even legally able to drive a car at 16. So I kind of always knew that I wanted to be in the industry.
Well, BMC was in the news. You guys made some news, and you just kind of shared the details about 3 acquisitions. I mean, tell us a little bit about those, maybe what drove them forward, and how do the 3 help shape the company going forward at this point?
Yeah, so the most recent round of deals was kind of fun. We operate in 3 verticals: aggregates, ready mix concrete, and then concrete products and building materials. So it was kind of fun to get a round of deals where we were able to close 3 separate deals in 3 different verticals. I would say, for the most part, we've been really spending our focus trying to build more geographic diversity. The business that I took over 20 years ago was just purely a small union shop ready mix operation in St. Louis in the metro area, and realized that I wanted to take the business in a different direction. And so most of our M&A activity has been focused on the vertical integration, heavy focus on ags, and then geographic diversification, getting into more markets, not wanting to be incumbent to any one general economic market, realizing that we needed to get outside of St. Louis. So most of the focus has been on that geographic diversification, Kevin. But the last couple of deals, we had an opportunity with Eureka Materials to come back into St. Louis Metro and get an ags deal. And you're just not going to get a permit to do an aggregate mining operation in St. Louis County in the metro area anymore. That's not going to happen. So being able to get our hands on 35 years worth of sand and gravel reserves was key. And then also, kind of experiencing some softening in the general market right now. And so coming back into St. Louis, acquiring the Ranieri operation was kind of more of a macro consolidating play, eliminating a competitor, expanding our market share, but also just a number of different synergies with the Ranieri deal that made a lot of sense for us to come back into St. Louis and do a deal.
Nathan, there's a couple key pathways to growth that you just touched on, the greenfield, which is obviously so much more challenging here in 2023, and it probably is not going to get much easier. And then there's the M&A route, which is a very active road for companies looking to buy. We talked offline about kind of what's happening with M&A here in 23, but as you think about growth and the avenues to best pursue it, what is the overall approach that you would say BMC takes, and maybe what is the opportunity with greenfield? As you kind of alluded, is it a little bit more limited depending on what market and how those sites are received or not?
Yeah. I'm not a big fan of greenfield. The vast majority of our growth has been through acquisition activity. I think that's part of the deal being in the Midwest, when you kind of come from more of a sleepier, low single digit organic growth rates, for us to continually perform at 15 to 30% compounded annual growth rates. We're only achieving that through the inorganic acquisition strategy. And that's really where we focus, and it's worked really, really well. We'll greenfield on the rare occasion when we need to fill a gap in coverage potentially, but greenfield's really the last thing that we're interested in. More or less trying to get more capacity taken offline, consolidating markets, bolting on new geography. But definitely prefer the acquisition strategy versus a greenfield strategy to achieve higher growth rates.
you guys are obviously diversified. We're a publication very much focused on aggregates, crushed stone, sand, and gravel. So as you think about your company as a whole, how does aggregates fit into it?
Clear number one. It's our focus. Ag's first in any market. The benefit of being vertically integrated, we'll do pure ready mix deals, we'll do pure ags deals, but ag's first. You think, the challenge to greenfield and aggregate operation in this day and age, especially with the regulatory environment that we're dealing with, some of the whipsawing between the administrations and the challenges that come from that. Anytime we have an opportunity to look at pure ags play, that's going to be priority one in our acquisition strategy. Like I said, we will look at pure ready mix, we'll look at products, precast, but getting our hands on aggregates is a clear number one part of our acquisition strategy.
How would you characterize the overall M&A environment right now? I mean, you guys are active in it, and I assume that you're probably looking at deals continuously and evaluating those. Seems like the nature of the deal making that's taking place here in 23 is different than the kind we saw back in 22, 21. Maybe bigger deals, smaller deals taking place now here in 23. You could make a case. So what are you seeing as you're somebody who's on the front lines of the deal making activity?
The opportunities are almost limitless right now. Having just closed 3 fresh deals, I want to say we probably have a dozen NDAs already signed in the pipeline. And it's, again, kind of in a variety of all 3 verticals are active. We've got small mom and pop shops to, some larger businesses that we're taking a look at. So, as we talked out, at the outset of our conversation, the interest rate environment is dramatically different than what it was just 12 to 15 months ago. So that's definitely having an impact. I think sellers are having to kind of recalibrate their expectations of valuations. Cost of capital has more than doubled in just a year, and that's pulling down multiples, and that's having some impact on, I think, how sellers feel about, everyone's very, very proud of their business and what it's worth. And I think cost of capital is definitely having some impact on valuations right now.
Despite what's happening on that front with the cost of capital, seems like aggregate producing companies are busy. Construction materials is healthy. I mean, there's demand for materials. Is that fair to say? I mean, how would you describe what's transpired thus far, 7 months into 2023 for BMC?
Yeah, it's actually, we're having a great year, surprisingly. And I feel a lot better about where we're at today than I would have said 12 or 15 months ago. We're definitely seeing some softening in the residential sector, residential segment, I should say. Commercial industrial, seeing a little bit of softening. The Amazon Society, the big box speculative distribution centers are kind of have come off here recently. But you saw in 2022, you had 12 continuous months of single family home sales in decline. That trend has reversed here into 2023. And you also saw builder confidence, home builder confidence, went above 50 for the first time in a bit. And so I think the softening in residential may be of shorter duration and not as deep as I would have, say, predicted 12, 15 months ago or so. In light of the softening in res and commercial industrial, we're finally starting to see the impacts of that $1.2 trillion transportation infrastructure spend that's coming online. So for a company of our size, with our vertical integration and geographic diversity, the opportunities that we see coming in T&I think are going to give us a better chance to exploit that segment and likely more than offset the softening that we're seeing in res and commercial industrial. So we're very bullish, which is also why we're keeping our foot on the gas on the acquisition strategy.
Yeah, on the infrastructure front, Nathan, with the IIJA bill there, it seemed like we've been waiting mode for quite a while. And when you say you're starting to feel that a little bit, maybe you can enlighten us a little bit. What does that look like right now? And are you pretty bullish about the runway forward tied to the $1.2 trillion bill you just mentioned?
Very much so. Very excited about it. I spent 10 years of my life lobbying on Capitol Hill to try and get a long-term, federally funded, fully funded transportation infrastructure bill. And where we're sitting right now, we're finally seeing some of the mega projects come online, some of the $200, $300, $400, $500 million projects that are coming online. Probably 85% of our revenue comes out of the state of Missouri. We've got one of the probably 5th or 6th largest networks of interstate highways in the U.S. And so some of that DOT spending coming on, we're seeing it. We're bidding some of the large projects. Also here in Missouri, the Missouri legislature passed a $2.8 billion bill to fully fund a rebuild of Interstate 70 between Kansas City and St. Louis. And we couldn't be more excited about that. The two biggest industries in Missouri, agriculture and what we do, construction materials. I think we're probably the third largest cement producing state in the union with 5 active cement mills. Having a massive investment in our biggest transportation corridor, getting agricultural products out of the center of the state to our multimodal ports in Kansas City and St. Louis. That multi-year reinvestment also has us very bullish. That's a construction project that'll probably go from 24, 25 to 2030, and huge economic impact for the state of Missouri, and especially for folks like us that are in the construction materials. That's got us really bullish.
Yeah, that's got to make you feel confident, even if residential or non-resident or residential or non-residential decides to go downward or not live along that same growth path. So what's your outlook in those markets? You shared kind of what you're seeing and feeling right now, but do you see growth opportunities there in tandem with things on the infrastructure side?
As I said just a minute ago, the softening in residential doesn't have me really concerned. I think I still have PTSD from taking over as CEO in the end of 04, first part of 05. I had, about 2 good years before the world came to an end. And having lived through seeing res go down 85%, having seen, my business get cut in half, having lived through that, we've largely underbuilt in residential. And so the softening that we're seeing, like I said, I think it's going to be fairly soft and hopefully of shorter duration than what I would expect a little while ago. Certainly some dislocations in non-res, but I think that the offset, people don't realize outside of this industry that we literally starved the nation for transportation and infrastructure funding for the last decade. And, finally having that fully federally funded bill coming online, seeing the projects come to market, it gives me a better outlook we've got better visibility into 24 right now, and I feel pretty good about
it. Nathan, kind of what you've characterized here is that business is good, materials are getting put on the ground and going into projects, and they will in the infrastructure realm maybe at a better pace or rate than we've seen. There's still those headwinds. Inflation's a big thing. Labor, that's something we've been dealing with for years. What's happening on that front? Do you see any improvements, workarounds? How do you describe what you're feeling with challenges like those? And is there anything else developing, surfacing on the challenge front that's kind of new?
No, that's a great question. So one of the things that we've seen, and we changed our business model about 5 years ago to focus really aggressively on margin generation and set a marker for EBITDA contribution that we wanted to see at the parent company level. And we've executed that. We suffered almost zero margin compression over the last 2 years, which I think is extraordinary performance considering the hyperinflationary environment that you just referenced over the last 2 years. Hyperinflationary environment in almost every asset category, whether it's labor, wages, whether it's steel, whether it's cement, whether it's ags, you name it. Hyperinflation was real. I think we managed that very, very well. Drove price where we can drive price, control costs where we can control costs. And what we're seeing in the M&A side is that there's a lot of producers that got caught flat-footed, that weren't actively managing and controlling costs and moving price where they could to offset some of the hyperinflationary situations that we were dealing with. So I'm very proud of our team and our execution in the last couple of years, and that's enabled us to keep our foot on that acquisition strategy, keep our foot on the gas of the acquisition strategy. That's also helping us in the valuation where we saw producers maybe they didn't manage their businesses well, and their profits suffered as a function of that, giving us some better deal value, if you will. As it relates to supply chain, Kevin, we're finally starting to see some things moderate. Definitely had some challenges in getting our heavy equipment delivered over the last couple of seasons. You've heard it 1,000 times, whether it was motors, switches, chips, parts, whatever. But we're finally starting to see some of that moderate a little bit. So I see that continuing to ease into 2024, making kind of our CapEx lift a little bit easier going into next year.
How is your planning because of the change with the supply chain been impacted? Everything I understand is that we're here in July, practically August, and I guess historically you go back 5, 10, 15 years ago, you can start to share your plans with your vendors and expect to get your deliveries when you need them for the following production season. But if you don't have your ducks in a row at this time of year here in 2023, you may not get those deliverables in 2024. Is that still fair to say?
That's still fair to say. In 2022, we received less than half of the capital equipment that we had ordered and had expected for delivery in 2022. And that definitely had negative impacts. We're all running some equipment longer than we wanted to. Replacement parts became challenging because we're running equipment longer than what we had expected. But again, that just comes down to management. And you see those things developing. How do you react to it? More importantly, how do you be proactive when you know that the supply chain challenges that we had were going to be multiple seasons long? Get out in front of it, manage your way through it. So that's just what's fun about managing a business. Love the challenges. Within chaos lies opportunities. And so, I've really enjoyed the last couple of years of difficult operating environments. But we've got a good team and we've managed our way through it really, really well.
Nathan, is there anything else you'd like to share with us? Anything you want to put out there to Pit and Quarry readers about BMC or things, observations you have about the market?
I think the biggest thing that we're excited about, as I said, the acquisition opportunities are limitless, and we're really looking to continue to build out a lot more of a super regional footprint, definitely with that ags focus, because that's something that we can build around. If we can ags first in any new market. We've got NDAs in 6 or 7 different states right now, really trying to build out a bigger footprint. Get an ags deal, build around that, backfill it with ready mix, backfill it with products, building materials, etc. But yeah, that's the biggest thing for us right now. We're excited about the operating environment. We're excited about our financial performance right now and our ability to grow, and trying to capitalize on this opportunity right now.
Well, Nathan, I appreciate you getting together with me here today, and we will certainly keep tabs on how BMC is performing and the deals you're orchestrating in the months to come and into 2024.
Kevin, thanks a lot for having me today, man. It's great to talk to you.
Thank you to Vandergraaf for sponsoring this Road to Prosperity video. To learn more about how their advanced drum motor technology reduces maintenance costs while delivering reliability and longevity for belt conveyors operating in the harshest of environments, visit vandergraaf.com.